Hey folks, today we want to have a look at bond yields and want to address the question that we continue to receive probably every day several times, and that is this it, or bond yields now going to start breaking out higher? And I think, of course, context here is important. So let's have a look at this. What I want to do before I go into the charts, what I'm going to do is we're going to walk through some bond yield charts on different parts of the yield curve, and then we're going to certainly very quickly try to see if we make sense of particularly how this might affect certain equities that you might be able to profit from. So let's have a look at all this. And what I'm going to do first, we're going to look at the benchmark 10-year yield. This is the U.S. Treasury note yield, not price. And you know what a lot of people have seen is what has been a quite sharp move for the past few days. Now we're getting into a point here that I think is going to have some technical resistance. There's all sorts of linear resistance from simple trend lines to even the 200-day moving average. So there might be some backing and filling here. Nevertheless, this is an important thing to understand. We just this morning actually got, I think, the highest PPI, producer price index. This is out of Spain. Since I think the 1980s, I want to say. So this continues to be a theme, and so we do think that the inflation metrics are going to be there. The question, of course, is how quickly, what's the rate of change in terms of bond yields? Let's have a look at the lower end of the yield curve, or the shorter end, as it's called. And here you see a sort of a technical, beauty, rounding bottom, then we consolidate, and now we're breaking higher. But of course, the question is, how could this benefit equities? I mean, an easy sort of explanation of what it could benefit is something like financials. Even though last week actually the yield curve flattened, where 2-year yield actually rose more than the 10-year yield, for example, nevertheless, it actually could still to benefit, for example, financials. So what I'm going to do is I'm going to take an ETF that tracks quite nicely what is basically stocks that should benefit a rising yield environment. And I'm going to make this a weekly chart so it kind of gets a bit less noisy. And for the most part, you can see we've got an index or a set of stocks that would benefit from rising yields that are consolidating, and sort of the path of least resistance from this perspective would be to the upside. What I'd like to do now is overlay this against the yield of the US 10-year Treasury. And you can see that it's more or less the same chart, right? You can see the equity prices that we just talked about. That's this candlestick chart. And then the 10-year yield on the Treasury is the orange chart. Even though they're at different points, of course, it's the same chart. So to me, when you look at something like this, it then automatically gets them to dig a little bit deeper underneath the surface. And it doesn't really matter whether we look at charts like this one of Bank of America, which is not exactly something that I would consider to be bearish. And I'm going to get rid of the 10-year here. Again, we're looking at the weekly chart here, so you can see this is a longer-term time frame. Or you look at something like PNC, which is also a bank, and we're consolidating. So I think the path of least resistance here essentially points to the upside with bond yields. Our base case would be that they're going to continue to move higher, but not at a very, very sharp rate. And that should benefit something like financials. So long financials, earnings season coming up, by the way, so there's always a near-term sort of volatility risk. Nevertheless, our case would be long financials. Hope it makes sense, and we'll see you soon.